Rate hikes in the US. These rate hikes are likely to be higher than anticipated, is what we got from the Federal Reserve's chair, Jerome Powell. He was testifying in front of the Senate committee, and he has been emphasizing the need for higher and faster rate hikes to temper inflation. Jerome Powell is also optimistic about the Fed's 2% inflation goal after the better-than-expected economic data that came in. On the other hand, the Eurozone has failed to register any growth quarter-on-quarter in the final 3 months of 2022 compared to the 1.8% growth that they reported a year ago. So how will the street price in these developments? And of course, right now I'm looking at the markets. What Wall Street is doing right now is the Dow Jones, after opening marginally in the green, has now gone in the red, 0.03% in the red, which means we are down around 10 odd points. The Nasdaq is still holding on to the green, but by a sliver, 0.06%, and S&P is also down in the red by 0.03%. So the markets right now are looking rather weak. We'll discuss the implications of what Jerome Powell has said with Peter Cardillo. He's joining us, Chief Market Economist at Spartan Capital Securities. Peter, thanks for making the time for joining us on the show. In light of these latest comments by the Fed Chair, Peter, what do you expect the Fed to do when it comes to the pace of rate hikes and the size of rate hikes to achieve their 2% inflation goal that Jerome Powell has spoken about? He has said that the ultimate rate hike will be higher than expected. What do you think that number could be before the Fed actually starts dialing down those interest rates?
5.5, possibly 5.60. And of course, we're looking probably at a 0.5 point rate hike in March. And, you know, the Fed is trying to correct its mistakes. They failed on inflation. They were blindsided by the COVID situation. They kept their foot to the pedal, injecting trillions of dollars into the economy. And as a result of that, we wound up with inflation that we didn't see in 40 years. So now they're trying to correct their mistakes, and at the cost of putting the U.S. economy and dragging the global economy into a more severe recession that the markets were anticipating. In fact, if you noticed yesterday and today, while most markets were under severe pressure, what did we see? We saw yields actually coming down, just like they're down this morning. So what is that telling us? Well, it's telling us that now the market is looking forward post-recession. And the fact that the 2- and 10-year spread at one point was at a full percentage point differential indicates a steeper recession ahead.
This is something that you're pointing out, Peter. You said the Fed has been blindsided and now they have to correct their mistakes. Going by the economic data that's emerging from the US, what does it really indicate about the strength and resilience of the American economy standing strong against these interest rate hikes that may not have been as substantial, but clearly not slow either? So how much of a hit do you think the American economy is going to take to bring it to that 2% inflation goal that the Fed chair has spoken about? You did mention recession, but how severely do you think the economy is going to get hit eventually?
First of all, the 2% the inflation target is not going to happen for many years. We'll probably see inflation settle down around 4%, which, you know, we've lived with in the past. And we could come out of recession with inflation at 4%. But the problem is that what we're seeing now is the residual of the bottleneck situation that we had that was caused by the pandemic. Once that wears off, I'm pretty sure that these numbers are not going to be that strong. And the number that's going to tilt us into a severe recession, well, I shouldn't say severe recession, but a steeper recession, is the consumer spending. Consumers cannot cope with higher interest rates. Remember that we came down to near zero interest rates, and consumers were able to spend. Income was rising. But now, with interest rates climbing, the the uh, uh, the debt to service, the cost to service this debt is increasing. At one point or another, that's going to be a big burden on the U.S. consumer. And so, yes, the numbers are strong, especially the employment data. We saw that today with the ADP, which said that the private sector created 242,000 jobs last month, higher than we were looking for. But that all will dissipate once the full effects of the interest rates penetrate the economy.
From what we are seeing in the US, I'm also looking at the Eurozone, which has not been able to get any growth going for itself. If you consider quarter-on-quarter action, and this in the final 3 months of 2022, it's actually 0% growth compared to 1.8% if you do a year-on-year comparison, Peter. So in terms of what we are seeing in the Eurozone and what we are seeing in the American economy, how do you think global markets are going to get affected? How do you think Wall Street is going to price in what is to follow by way of Fed action and, of course, from the ECB as well?
Well, for one thing, I still think we're headed for a global recession. What happens here is going to be very difficult for the other G7 nations to escape. Maybe you might have one or two emerging markets that might escape a recession, but certainly they're not going to grow at potential rates. But as far as the impact of interest rates, if we continue to move higher here, obviously Europe is going to do the same. And it seems now that perhaps the interest rates hikes that we saw by the ECB is beginning to have more of an effect than what's happening here in the States. So they're going to continue to raise rates. Otherwise, the spread is going to widen even further between U.S. interest rates and global interest rates. And that just simply means a stronger U.S. dollar.
Indeed, and that's going to play out on the American currency. We'll see how that affects emerging market currencies like the Indian rupee. But of course, that's for later. Peter, always a pleasure getting your perspective, and we look forward to more on India tonight. Thanks indeed for joining us.